Over the last 12 months, the majority of the S&P 500 has been up very strongly, as we can see, pretty much green across the board. However, some companies, unfortunately, like Pfizer, have been beaten down. As we can see, it is down 23% over the last 12 months. And in today's episode, we're going to take a look at 6 of these stocks. We're going to run them through our valuation model. We want to understand what is their intrinsic value, what is their acceptable buy price, given our own investor margin of safety, and do Wall Street also see some nice upside with each one of these 6, and are they undervalued enough for us to consider adding into our portfolios? So the first one, Pfizer, as we said, down 23% over the last 12 months. We do get a double buy rating from Seeking Alpha from Wall Street with a hold from Quant. It is trading right there towards its 52-week lows, and it does now have a forward yield starting at 6%, with a forward P sitting around 11.9. Now, over the last 12 months, you would be down. Also, over the last 10 years, you would be down around negative 3.5%. Bear in mind, if you were to reinvest those dividends, it would be up, although marginally higher, and it hasn't yet recovered from its all-time highs of around the $60 mark in December 2021. Now, when we take a look at this company, it does get a safe score on the dividend safety at 75, and we do note it did have a recent increase to their dividend in December at 2.4%, although that is lower than the inflationary target that we always advise of 4% or more. In terms of the valuation then of Pfizer, let's get straight into it. As always, we do typically run through each one of these models, explaining the inputs, the outputs. Today, we're going to get straight into the intrinsic value, and we see just over $32. Now, in terms of the current price at just under 28, we like to implement a margin of safety, which we start off with 10%. We execute on that if it meets our 3 important criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Pfizer, well, it would be a buy at around $29. Then we keep going till it's near the current trading price, and we can see it isn't too far off, around 50 cents shy from a 15% MOS level. So in today's episode for Pfizer, we have a 15% margin of safety. In terms of Wall Street, well, they do indicate upside, 16%. Their price target around $32.57 isn't too far off our intrinsic value. The next beaten down stock we have is Nike. Now, no surprises, we did cover this in detail after falling after their earnings just last week. They are down 33%. That is 1/3 of their market cap wiped off over the last 12 months, and over the last 10 years, you would, however, still be up 92%, although you would have underperformed the S&P 500, and we do see all-time highs sitting around $178. This is nearly now 3 years ago. No surprises then, it is trading at its 52-week low. We have a buy rating from Wall Street with a double hold from the other 2 analysts, a forward yield that is pretty much around the 2% level, and a forward P 22.53 that is pretty much in line with the S&P. In terms of dividend safety, well, it still has a very safe score, 99, the highest score obtainable, and they have increased their dividend quite nicely, high single digits, just last November. Now, in terms of Nike, the evaluation, the intrinsic value, don't forget, if value is provided, you enjoy the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. With an intrinsic value just under $101 with a current price of $75, we get a 10% margin of safety indicating a buy at $91, at 15% around $86, at 20% around $81, and we can see in today's episode it is trading at a 25% margin of safety. In terms of Wall Street and their estimations, well, they pretty much see a price target around our intrinsic value, $100, indicating 33% upside just over the next year. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article, 10 undervalued stocks with phenomenal balance sheets. If you want access to this or any other articles, it is all completely free. You get instant access straight away by clicking on that pinned comment below. The next beaten down company, we have Bristol Myers Squibb, ticker symbol BMY. Now, this is down 35% over the last year. Over the last 10 years, you would be down 14.5%, and we can clearly see all-time highs around $81, pretty much double that current trading price. Also another one that is trading at its 52-week lows with just one buy rating from Seeking Alpha, a double hold, and a forward yield not too far off that of Pfizer at 5.78%. In terms of dividend safety, well, it does look to be safe, a 70 score, and they did increase their dividend 5.3% just last December. So in terms of Bristol Myers Squibb and that intrinsic value, and as a reminder, you can grab a copy of this model running your own numbers through for any company that you wish. We can clearly see a current price of 41, an intrinsic value of 52. Again, a nice bit of margin of safety. 10% a buy at $47, 15% a buy at $44, and at 20% we can clearly see it is at that current trading price. So if that is sufficient, it does look like an acceptable buy if you believe in this company over the longer term. We also see Wall Street indicating upside of 26%. Their price target over the next 12 months is thereabouts with our intrinsic value. We then move on to a horrific company, Walgreens, which is, as we can see, down 58% over the last 12 months. Over the last 10 years, down 83%, and it is trading right there at its 52-week low. We get a triple hold. Every single analyst is indicating not a buy, not a sell, just a hold. In terms of the yield, now even after already cutting its dividend not too long ago, it is forward yielding 8.3% and a forward P that looks incredibly low at 4.25. In terms of dividend safety, even after their dividend cut, it does say 30, it does look to be unsafe, and we can clearly see, as we mentioned, they already cut that dividend once, 48% in January 2024. In terms of the valuation then of Walgreens, it is arriving at an average of these three, which as we can see, 1053, which is the first company today that we actually see with an intrinsic value lower than the price that it is trading at now, indicating this is trading at a premium. If you were looking for a 10% margin of safety, you would have to wait for around $9.48, 15% around $9, and at 20% around $8.43. But as we said, right now it is trading at a premium. And in terms of Wall Street, they have now updated their price target. They give it a $10 price target, not only lower than our intrinsic value, but clearly lower than the current trading price, with downside implied of 17% over the next year. One of the first times we have seen this on the channel. We then move on to Lululemon Athletica with a double buy rating, Seeking Alpha and Wall Street with a hold from Quant. This one is down 21% over the last 12 months. Over the last 10 years, however, it is up 601%, clearly outperforming the S&P, and we can see its all-time highs sit around the $515 mark. Again, another one trading at its 52-week lows. Now, whilst this doesn't pay a dividend, we can see a reasonable forward P, 20.85, again below the S&P. So jumping straight into their valuation, given there is no dividend safety on this company, it is arriving at purely the DCF price at $410, with a current price which would indicate a lot of undervaluation. Margin of safety at 10%, a buy up to 369. At 50% up to 348, and at 20% we can clearly see this still has a nice margin of safety. At 30% it isn't quite there yet, so in today's episode for Lulu we do see $307 as an acceptable buy, which does give you a margin of safety of 25%. In terms of Wall Street, well, they also see pretty much the price over the next year in line with our intrinsic value. They are calling this 37% implied upside over the next 12 months. Again, definitely one to consider for the portfolio if you believe this over the longer term. We then move on to Ulta Beauty, again very similar to Lulu, a double buy with that hold from Quant. It is also trading at its 52-week lows with a forward P which is actually much lower at 14.97, also down 16.5% over the last 12 months. Over the last 10 years, another one that has outperformed the S&P, up nearly 300%, and we see all-time highs around the $575 mark. So moving straight into the valuation for Ulta Beauty, we can see in today's episode the average of these two models arriving at $507. So again, very similar to the previous company, a nice margin of safety. At 10%, a buy up to 456. At 15% up to 431, and we keep going till it's near that current trading price. Today's episode, it is a few dollars away from a 25% margin of safety, so we can clearly see, based on our estimates and judgments, a 20 to 25% MOS level. How about Wall Street? What do they believe? Well, they also see some very nice upside. They don't see the price right there at the intrinsic value over the next year, but their price target, $480, implied upside over 25%, indicating that they do believe this as a strong buy. So today's episode, we ran through 6 beaten down companies. We had Pfizer, we had Nike, Bristol Myers, Walgreens, Lululemon, and Ulta Beauty. As always, let us know your thoughts in the comments below, whether you're adding to any of these in the portfolio, maybe they're on their watch list, or very obviously, maybe like Walgreens, this isn't one you are looking to touch. As always, if you enjoyed today's content, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.